So we got a pretty interesting topic tonight. If you're actively investing in real estate, you may have seen that the market's a little wonky right now between the DC area and Baltimore area. Nothing crazy, but a little bit wonky. Quick show of hands. Who here has owned a investment property prior to 2008? So everybody there, okay. Just put a show of hands to see where we have. Okay, there's curious. All right, well, Josh is going to jump in. We've got a pretty interesting topic, how to capitalize on today's market panic, really good tidbits. Josh already shared his presentation with me, and it's a lot of good stuff. So Josh will speak for about 45 minutes or an hour, and then after that, maybe we'll do a quick expert roundtable with some local investors that are doing deals today that have come out tonight, and we can all ask them questions, and then Josh will stick around for Q&A as well. Okay?
Cool.
Thanks.
Awesome.
Try to get close.
I will.
Close
Okay.
to that.
All right. How's everybody doing tonight? Good? Awesome. All right. So this evening, we're going to talk about the market panic that nobody knows about yet. Well, let's call it that, okay? And might never happen, for that matter. But we're going to go into, we're going to cover a bunch of topics. Jason, can we? All right, hold on here. Okay. So this is my cheat sheet as well as my presentation. So sorry about that. All right, if you've never heard me speak before, I'm not good standing up here and just dictating all night long. If we do that, you're going to get bored. I'm going to get bored. It's not going to be fun for anybody. If you have questions, anything to add, chime in. Throw your hand up, whatever. And it's much better if we can have a dialogue here. Okay? All right. So with that as our backdrop here, I want to start with why this topic and why right now. Okay? I mean. We don't have a packed room here tonight. This isn't the most sexy topic in the world, so why did we choose the market panic of 2019? So right now in a general real estate cycle, we're approaching the top. We probably have already hit the top of the market. It's just the ebb and flow of property values. It happens just like in the stock market. We're already seeing cracks in that system, and they you can see those with some of the crazy fluctuations in the stock market toward the end of 2018. That's an indicator. We've got increasing inventory on the market right now, even though prices are not really regressing. A year ago, we had less than 3 months of inventory on the market. Now, it's closer to 5. So we've got an increase in inventory. We also have an increase in interest rates. So we've got a couple things coming together here that are little alarm bells. And why are we talking about this now? Because it hasn't happened yet. Now's the time we should be talking about it. Otherwise, we're talking about history. At this point, you can plan, put your business in place, and look for opportunity while everybody else is just figuring out what's going on. Okay? All right. So why this topic? In 2007. I was kind of depressed. I had been wholesaling properties. I had 3 properties that I bought that was trying to flip, and then the subprime market tanked, right? And all 3 of my flips were in subprime markets, and not a great place to be. And I kind of felt like I missed the jackpot, right? Because in 2005, 2006, property values were going up so fast. You could buy a house, hold it for 6 months, put it back on the market, and make 50 grand. I mean, that's a pretty good market. And at the time, I was looking at this and saying, man, I totally missed the boat. We'll never have a day like this again. It's so depressing. And as I'm looking at this and getting depressed, being upset about this, I totally missed the huge opportunity that came around as we hit the bottom of a market and then had a huge rebound. And so I'm talking about this today so that when these things happen, when some bad things happen in the market and prices start going down, you don't panic. And you can see, hey, we talked about this. I remember going to that meetup, and now these indicators are happening. All right, well, let's see what happens next, okay? And, I felt like, in retrospect, I kind of missed the forest for the trees. In that, I was upset I missed out on those transactional fees that put money in my pocket. That stinks. But the forest here, excuse me, the forest that I was missing was this huge opportunity to get a ton of wealth, to build a ton of wealth as the market tanks and then ride it on the upswing. So anyway, these are the things that you shouldn't do. This is what I did, right? As we go through this correction or a big shift in the market in the next coming months or years, you'll be ready to go. Okay, so that's why I chose this topic. This is why I want to talk about it now, and we'll kind of use that as a jumping off point. Jason, where you go? Okay. Anybody here like high school or college wrestling? Oh man. Okay, so I'm kind of a freak. I wrestle at the University of Maryland. I love college and Olympic wrestling. I coach youth wrestling, and so I'm going to use Penn State's wrestling program as kind of an illustration here for some points I want to make. Okay, so Penn State has a dynasty that started about 8 years ago. In the last 8 years, I'm sorry, it started 9 years ago. In the last 8 years, they've won 7 national championships. 9 of their wrestlers, there's 10 starters, 9 of them are in the top 10, and 4 of them are ranked number 1. So I mean, they're a really dominant team. Their coach is this guy, Cael Sanderson, okay? Cael Sanderson is the only 4-time undefeated national champion. He changed the sport, okay? He's been able to consistently attract the best athletes and train them in a way that makes them different than everybody else. They perform better in key situations, key matches. And their whole success is built on the system. Now, I was reminded of this past weekend. It's kind of interesting. You know, he's got this mantra, this coaching mantra that is, you know, just trust the system, just trust the system. We know what we're doing, trust the system, everything will be okay. Well, last weekend they wrestled Wisconsin. They looked terrible. You know, they only won 7 out of 10 bouts. I mean, it was a terrible day. They gave up 2 upsets, and there's a lot of talk in the wrestling community. These guys, maybe they're not really well prepared, what happened this week, all that. Well, I was listening to this podcast on wrestling, and they start talking about this, and then they rewind to 1 year ago, literally 1 year and 1 day ago, from the same podcast, and they talked about the same thing happening to the same team during the same time in the season. And it was like this eureka moment. Well, they have this system that allows these guys to train throughout the year and prepares them not for matches in the middle of the season, but for what is going to happen at the end. And if they follow this system, they might lose a match in January, but when it comes March and it's time for the NCAA tournament, when the wins matter, that's when the system comes together and the success happens. Okay? The second thing is that, you know, knowing that there's going to be ups and downs. Okay? Who cares if their guys lose? You know, this coach, he doesn't care if their guys are losing in the middle of the year, because the prize is at the end. It's the same idea with real estate here. Here's the parallel I'm making, okay? Number 1, trusting the system. Knowing that real estate values go up and down in cycles. And that there's certain indicators and certain things that are going to impact those cycles and, you know, have an impact on how quickly values recover in a down market and how quickly they go down in an up market. Also knowing that throughout this cycle there will be ups and downs, that if you're buying a property and holding it, the value will probably go down during your ownership. But unless you want to sell on that day, it doesn't matter. If you're looking in a long enough window, everything's going to be fine. And that just comes to the end. You know, keep your eye on the end game. The goal here, whoops, make sure you know your goal and make sure that the performance of these assets, of these investments, are going to be the best when it really counts. Okay? Now, was that a reach, Penn State wrestling and real estate? I mean, not too much? All right. Okay, Jay, can you give me, all right. Okay, so where are we in 2019 real estate market? Give me some feedback. Any agents out there, can you tell me what's going on in the market? And any investors that want to give me some feedback on what's happening in the DC Baltimore market right now? Go for it.
Well, I'm a new investor, and I do digital marketing for real estate agents, but all last spring they were crying about, no inventory. And then they got to the summer and it slowed down to nothing. So why do you think this is happening now, the decreasing demand? And did everybody buy?
That's a great question. So the question is, why is the demand different a year later? And you know what? For a while I couldn't figure it out either. I mean, it doesn't make sense. Interest rates are going up, but they're not going up that much, right? Inventory is higher, but it's still not on pace with demand. So why do we see this lull in demand, and why are properties not moving? Anybody have any ideas?
People are scared.
Nothing? What's that?
People are worried about the market.
They're worried about the market. Okay. All right. I mean, really, that uncertainty, right? We've got two big psychological motivations: greed and fear, right? They're the two things that cause people to react irrationally. And we all know that you make money when you buy low and sell high, right? But what does everybody do? They buy high and sell low, right? So these are some contributing factors. But if you look at the factors right now, the conditions are: we got rising interest rates, not big rises, but incremental interest rate rises. We have decreased affordability caused by those interest rate rises, which is leading to a decrease in demand and increasing inventory. So if you've got decreasing demand and increasing inventory, you're going to probably have a price reduction. But my conclusion in looking at the market, we're about to reach our peak, but this is normal. It doesn't look like there's a huge crash. Jay, can you get the next one? But when we look at the 2019 economic market, things are a little bit different. Now, this is going to get boring, so I'm going to go quickly. All right, so bear with me here. All right, here are some market conditions. We have a high level of consumer and corporate debt, higher than is probably appropriate, but it is what it is. We've got increasing interest rates, decreasing money supply. The Fed has announced that it's going to start selling off some of the debt that it did during the quantitative easing, which is going to restrict the amount of money that's out there in the money supply. And then, we've got ups and downs in the stock market. But here's what's weird about the stock market. This is what really kind of threw me off. Why would stock prices decrease when you have strong earnings reports? Why would the stock market decrease when, a lot of these companies, there's real value behind them. They're long-term companies. They continue to produce a profit. There's demand for their goods and services. And here's what, anybody out there know Ray Dalio? You heard him? Okay. So he's an economist and a businessman, but he wrote an article a couple weeks ago on this situation, like why are prices going down when all the other indicators are good? And he's pointing to two things: the short-term debt cycle and the long-term debt cycle. This gets real boring, but here's the bottom line. Short-term debt cycle is a 5 to 10 year period. The idea behind this, actually, Jay, can you give me one more? Okay. All right, so basic economics, you've got increasing demand. Increasing demand causes an increase in prices. An increase in prices, higher profits, which increases competition. More people want to get in there and get a piece of the profits. Now you've got increased supply, which leads to decreased prices. Make sense? This is this is the backdrop. This is the underlying principle that is causing some of these fluctuations. Now, the central banks, like the Fed, they try to regulate the economy. And they do that by changing interest rates, injecting money into the system, and building tax law so that they can inject additional money into the credit markets. And by introducing additional money, all of a sudden we have inflated demand, right? And it takes us through this whole cycle. And so the central bank is going to manipulate the interest rate and the amount of money in the system to incentivize the growth in the economy, and then they're going to restrict those things when it looks like things are out of control and inflation is happening too quickly. Now, on a short-term debt cycle, that 5 or 10 year period, we can see this as we cycle through the economy. Jay, give me the next slide if you would. Okay, so if we look at this, this is the GDP and the interest rates from 2000 to 2018. And what we see here is that from 2000 and from 9/11 basically till the crash of 2008, we've got one debt cycle. Okay, GDP on the top here, it goes down, climbs back up, and starts that downward decline. Coincidentally, interest rates are following that same curve. They go down, increase, and go back down. And you can see here that from 2001 to 2008, we've got 7 years. That's one debt cycle. We've got the same kind of curve happening on the tail end here from 2008 to 2018. You've got the downslope and that slow climb. It's just a longer time frame, okay? So what we have here is we've got the tail end of a short-term debt cycle happening right now. And on the long-term debt cycle, this is the same kind of idea, except it's strewn out over a longer time. And what you tend to see happen over a 50 or 75 year period is that the central banks, they're going to manipulate the economy because they want to continue growth. And then when growth gets too fast, they're going to cramp down on the interest rates to slow down the growth in the economy. And when the growth, when they continue to manipulate the economy and the impact of that manipulation continues to have a smaller and smaller and smaller impact, after you go through a couple of these short debt cycles, you end up with the end of a long-term debt cycle where now the central bank cannot pump more money into the economy. They can't lower interest rates. And so you end up with a situation where you have a natural reset of that cycle, and now we start over. Well, right now we're at the end of a long-term and the end of a short-term debt cycle. And guess what some of the indicators are when you get to the end of one of those long-term debt cycles? Anybody guess? You have, you have asset values decreasing with no real indicators. And that's what we have right now. We have a stock market in decline. When we have underlying principles for those companies to be very strong, we have a strong economy in general, but yet the stock market is going down. Well, another asset that decreases during a reset in these cycles is real estate. And so you've got the opportunity here, the likelihood here, where we're going to have a correction in property values. It might not be a big deal at all. It might be a really minor correction that we see, 5%, 10%, 15% max. Can you go back to the prior slide? Okay, great. Okay, I want to go back here to these tools that the Fed uses, okay? I think this is important and it's going to show up later. First one is interest rates. We've seen the interest rates rising, got that. The money supply. This quantitative easing, and you guys have heard about this in the newspaper or you've seen it online. Everybody know what I'm talking about with that? Yeah, okay. All right, and then the last thing is these targeted tax incentives. And we saw this with, when we were recovering with some of the injections of the capital, like some of the tax incentives that were out there for like cash for clunkers. Remember cash for clunkers? Get rid of your old car, buy a new one. The first $5,000 will be a tax credit. Great. What did we see? What happened there? The value of all those cars went up $5,000, amazingly. And we had the same thing with the first-time home buyer credit during the same period of time. All the values went up $5,000, $5,000 in closing costs. These are things that are going to impact the economy, and they're tools that the Fed uses. So now, all right, we talked about that. Jay, can you jump forward to? Okay. All right. So 2019 economic projections. We're going to see interest rates continue to rise. We're going to see corporations and institutional investors. They're going to begin to sell off stocks. So here's what happened. Money got so cheap that a lot of these corporations, they took out a lot of debt. And they used that debt to buy their own stock. And basically what they were doing is they're borrowing money at 2.5% or 3.5% or 4%, and they're getting an 8 or 9 or 10% return on their stock. So they're keeping the arbitrage. But as interest rates go up, that money costs more. And as the stock market goes down, that arbitrage gets smaller and smaller, and they may be losing money. So guess what they're going to do? They're going to sell their stock. And so you have a lot of stock sales. It's going to cause the inventory to be high, demand will be lower, it's going to lower the stock market, and that's going to cause a lot of fear and uncertainty. And when there's fear and uncertainty, people make poor decisions. Property values will likely go down, but when people start making poor decisions, that's when we collectively start making great decisions. Okay? So with this as our backdrop, let's talk about how we can capitalize on this moving forward. All right? Jay, can you give me the next slide? Okay. All right. So I have three. What's that? Questions? Yep, please.
Actually, before you move on, I think great points on the economy, right? So
Yep.
two first down cycles. First we had .com bubble crash, right?
Sure.
And then on your chart you showed that it's like the interest rate rises from 2001 to 2004.
Yep.
Span hiking.
Sure.
Quarter, and then the second one was toxic mortgage.
In 2008.
Yeah.
Yep.
Toxic mortgage. So, what do you think is the catalyst now? So you think it's more like a silent killer, if you will, right? We don't have the extreme catalyst that we had for the first two down.
Absolutely, sure.
Right.
What do I think that will be the catalyst?
Do you think that trend's going to continue? Do you think something's going to appear that?
Well, I think it already has. So to answer your question, it can be as bad as some people are projecting that the stock market is overvalued by 42 to 53%, which would mean a drop in the Dow Jones to like what, 12,000. That would be a big deal. Like that's pretty awful. And whether real estate follows the same model or not, it's going to have a big impact on the real estate market as well. Could be that bad. It could be a $5,000 drop in property values in the spring slowdown, and that's it. It may be nothing, but it may be something. So we're talking about this so that when these indicators start popping up, and people start seeing people on the news start talking about foreclosure, and there's a special report on how terrible things are and the housing market's dropping, and this person just got they lost their house to foreclosure, and over here foreclosure rates are rising. When you start hearing this stuff, and you stop seeing the ads online for I don't know how to make $1 million in the next 10 minutes in real estate, when you start seeing those ads online, and those things start disappearing, start paying attention. One of the best quotes that one of my favorite quotes, I forget even who said it, but the quote is, everything popular is wrong. If you go in with that premise, look for the way everybody's running and go the other way, right? Okay, so I've got three exit strategies that I use with my real estate investments. Wholesaling, I look at that as my short-term income, it pays my bills. Flipping, this is for windfalls of capital that are mid-term income, looking at 6 months out, and then buy and hold. And the buy and hold investment is the best investment. It's the one that pays you every single month, forever. This is where the real wealth is built. And in an environment where there's a lot of risk and a lot of uncertainty, there's also a lot of opportunity for an upside. So a couple things that we're looking at wholesaling. So first of all, if you're wholesaling properties and that is your main source of revenue, you're going to expect your wholesale fees to drop. In 2010, when I was wholesaling a lot of properties, we went from making $20,000 or $25,000 on a wholesale fee to making $2,500 because nobody had any equity left in their house. I can remember going out and I can remember talking to a young lady who just bought a completely renovated property not 6 months prior, The market tanks. All she wants to do is get rid of her house. She's willing to sign the deed over to me if I take over her mortgage. And I mean, this happened to me many occasions, you know. Crazy things happen in the market. People act irrationally. Just keep your eyes open. So here's what you'll see. You'll see fees drop for wholesalers. You'll see reduced competition in marketing. You'll also see, you know, reduced opportunities with buyers because a lot of newer buyers are going to disappear. You know, you're going to have reduced opportunities because of decreased prices and decreased equity. The best thing to do in this type of market, if you're going to be wholesaling, is to target areas that are median home price and developing areas that have kind of cooled off as rentals. The fix and flips, here's the beautiful thing about real estate. People always need a place to live. And we're not in a situation financially in our country where banks are not willing to loan to qualified buyers. So there's an opportunity here if you want to flip houses. The opportunity is, in my opinion, this is like the best time to flip when there's less competition for deals, there's less people that can have access to money, and because of that, there's big upside. Focus on median home price areas and look for properties that you can have a plan B if you can't sell to keep them in rent. If they cash flow, then that's great. And then buy and hold. So fearful buyers, when they, okay, so this is what I'm gonna say about buy and hold. First of all, it's my favorite part of the business to talk about. Because the value of time can add to the asset, even if you're buying at market value. This is an area that I've seen such huge upside, and it's a area where you don't have to worry about today's value because you're projecting out, you're looking at the cash flow, and you're not so worried about, you know, what the house is going to be worth when you sell it. But when the market goes down, this is a great opportunity to go into neighborhoods that were in the beginning stages of gentrification, or you know, they were becoming a hot market. And so you have a couple rehabs in the area, but this is also the type of location that's going to take a big hit when you know, when there's not 50 people lined up to buy every house that hits the market. So the values are going to come down, but it's also an area where when the market gets better, it's an area that investors are going to come back to and start reinvesting in. So if you can get something at the bottom, even if it's not renovated, it's the kind of thing that you can get some cash flow for a couple years, and the upside in those gentrifying neighborhoods is going to be really big. You know, I've seen this in a couple different neighborhoods, but a good explanation is like a rubber band, right? When you've got, the more slack you have in the rubber band, the more capital has to go into the market to absorb that slack. But that's the total amount of money that's got to come out of the market when it's time to sell. So basically, when you're buying in these areas, you can expect a really high outsell, but you can still buy at a good price to start. All right. Jay, you want to jump ahead? I want to stop here and just kind of catch up here. Any questions on anything I've covered so far here? Any comments? Nothing. Well, we have like 45 minutes and 2 slides left, so. No, I'm kidding. All right. So when you're looking at a plan moving forward, okay? My focus is, as I mentioned, first in buy and hold. The goal here is going to be cash flow over anything else. And you know, if you're focusing on cash flow in areas that are going to be either very consistent or have a very big upside, you have a long time to wait. You can wait as long as it takes for that market to recover. If it comes back in 3 years, fine. If it comes back in 12, fine. You're getting paid all the way along. So you're able to choose when you're going to exit from that property. I talked about the developmental areas and just kind of focusing on up and coming neighborhoods that are reaching a chill point. But consistent neighborhoods are fantastic I mean, across the board when it comes to cash flow. We're talking about bread and butter areas, median home prices, areas where a lot of people want to live, not a lot of not a lot of crime, all that kind of stuff. This is the time when you can actually get a foothold in some of these neighborhoods that they don't have a lot of variance in the sales price. You know, you look at a neighborhood and you got a rehabbed house selling for $325, and the fixer-upper handyman special sells for $275. You know, you got to put $100,000 into it to get to that $325. But those are the consistent neighborhoods that if you can get a good cash flow property, you can wait until the price escalates.
Yeah, no, I mean, I definitely agree with your comments there. I have a question. The Trump tax plan, there was a provision in there for like
The opportunity zones?
Exactly,
Yeah.
Mm-hmm. Yeah. I didn't want to jump in. I don't know if you were going to talk.
Well, no, it's part of that,
You
yeah.
said developments. Okay, yeah. I'll wait.
No, that's cool. That's all right. So, what's your name? I'm sorry?
Oh, Victor.
Victor. All right. So, what Victor's talking about is there in 2017, part of the tax plan, the Trump tax plan that was passed was the formation of 300 and some odd opportunity zones across the country, and all of the governors of each state, they got to name these areas, and basically they would name the areas throughout their state where there's massive federal incentives for development. The idea here was to introduce capital into neighborhoods that didn't typically, have that opportunity. And so in these zones, if you have capital gains, you can take those capital gains and you can invest them into these opportunity zones. There's a couple steps you have to take, but the idea here is that number one, any capital gains invested in these opportunity zones have an immediate tax deferment. You don't have to pay taxes on that money until you sell the property. If you hold the property for 5 years, is it 5 or 10%, Chip? I think it's 5% after 5 years, 10% after 7 years, and if you held the property for 10 years throughout this program, they would forgive all of the taxes on that original capital gains. And the real kicker is that in these zones, if you hold the property for 10 years, there's no capital gains on the new property either. So, I mean, there's a ton of money being pumped into these zones across the country. And one second here. There's two big opportunities in the opportunity zones. If you have capital gains to defer, it's a great place to do it. I mean, you can offset the taxes and all that stuff. But if you don't have capital gains to offset, it's great to invest in these neighborhoods anyway, because there's there's billions and billions of dollars that's being invested into these zones throughout the country. Yeah.
Just an opinion question, but do you think that so now you've got this tax basis, and you're absolutely right. The opportunity zones are there, you park your money, your cost basis will reset after a period of time. Do you think that would hasten maybe the fleeing of money out of capital markets into, don't you think that would have like a counterintuitive effect, right?
What do you mean?
Like I'm going to sell stock and take my money.
Okay, so your question is whether the opportunity zone has a counterintuitive effect. They are selling another asset. I mean, I don't think they were set up that way. We may well see that because of the stock sell-off last year, but I mean, here's what this is. We talked about the cycles, right? And like the Fed puts money into the system to incentivize growth, and they take it out to slow growth down. This is essentially an injection of capital specifically into these areas. So you're going to see growth and development in these areas one way or another. There's a lot of hedge funds that are putting a lot of money into larger development programs, but locally, small investors can take advantage of this themselves, either by doing the development themselves or going through a third party that is set up for the opportunity zones. Sorry, you had a question over here, I'm sorry?
Yeah, I was just wondering about the zone that you guys are talking about. Is there like a list somewhere? Like how do you find out where these specifically are?
I want to make sure I'm hearing you right. Can you repeat that again in 1 sec?
Find the opportunity zones.
Oh yeah, sure. Okay, if you Google opportunity zone map or in the state or whatever, you can pull it up. And I mean, like there's a federal website where you can search by zip code, or you can zoom into specific areas, and it'll show the areas that are mapped out. Most of them most of them are in areas that need capital, that I think would benefit a lot from capital injections, but there's also some zones that you look at and you're like, man, somebody owns some properties there and has some connections in government. Who knows? But yeah, the opportunity zones are an added benefit. This is also, like kind of an asterisk on the opportunity zones. There's too many good opportunities out there to, buy a bad deal just because it's in a tax incentive zone. If the cash flow doesn't work, don't buy the deal. Start there, and then look at other benefits. All right, so when you're basing your values, this is the other thing. As the market retracts, you want to be really super conservative when it comes to your after repair values and when you're looking at cap rates or values of these assets on the cash flow and what kind of cash flow you can expect. I try to look for a 10% cap rate on anything I'm looking at. In a downturn, I also want to see equity in the properties when I buy them. It's less important for me on a buy and hold than it is on a flip or on a wholesale deal, just because of the timeline. But you should see both cash flow and equity there. On a fix and flip, the goal here is one thing. We're only looking for home runs. That's it. If there's not $50K to be made in the deal and it's not a bread and butter neighborhood and it's not a straightforward flip, it's not for us, right? We'll wholesale those deals. But if we're gonna flip, it's gotta be a home run. Now's the time to look for those, right? Now's the time when they'll present themselves. So we're looking for deals that have at least $50K in profit and conservatively so. Second, we're looking for deals that can be backed up by cash flow. If for some reason the market disappears for this property, can I rent it and get it at least break even cash flow on a fully renovated property if I have to hold it for a year or two? The next thing I'm looking for, right now, what are you guys using to evaluate properties? If you got to throw a quick offer out there, what's your percentage? What's the formula you use to put together an offer? Are you doing 65%? Are you getting anything close to on your offers? Really? Okay, all right. I've been seeing a lot closer to 70 and even 75% in a lot of markets on offers that are getting accepted. And I mean, it's a good recipe to really slim down your margins. When you're on the upswing, if you're doing that, a lot of times the increase in property values during that upswing can absorb some mistakes on the front end. At this time in the market, you want to make sure that you're looking at 65% of a realistic sales price, and we're not talking about the top of the market. We're just talking about here's what the cycle looks, or here's what I'm seeing as a trend. You get an outlier sale at 285, but everything else is selling between 250 and 260. Hey, it's worth 255, right? Be aggressive with your construction as well. You've got to be, and I say aggressive, I want to overestimate my construction a little bit at least. We're looking at only median home sales prices. Nothing on the real high end, nothing in a new home buyer market. These two areas are going to be the most hit if there's a drastic change in price. And then last, we're looking at 90 days worth of comps. Usually I'm looking at 6 months of sales, in the same area, things like that. But as the market turns as values start to drop, I want to see where they are in the smallest possible window. And then wholesaling, anything that doesn't fit the first two models, I'm going to wholesale. This is a great opportunity to meet really good investors, to build your network. The people that are going to be buying now are going to be people that are in the business. They've been doing this for years, and a lot of them are experts. They're seeing a downturn as an opportunity to build their portfolio. These are people that you want to be close to. It's a great time to fill up your buyers list with great cash buyers and build relationships with those people, so that as you move forward, maybe you're looking at it and the market changes and the cycles change, maybe you look at something bigger and better. You want to build new construction or start doing condo conversions, or who knows, in the years to come, these are really great connections that you can make as you're in that downturn. All right. So where do we find the deals? Who here is actively marketing for real estate, for discounted real estate deals? No? All right. Where are you looking? Where are you marketing? I'm going to start in the back here. Where? Where are you? What are you currently doing to generate leads for motivated sellers? Through a realtor? Okay. Anybody else? Here you go. What do you got? Yeah.
Calling old LoopNet listings for multifamily.
LoopNet?
LoopNet.
Okay.
Calling landlord signs.
Yep.
Rent signs.
Okay. Landlord and rent signs. That's good. Anybody else? Okay. There's lots of places to find motivated seller leads. The best ones are directly from the sellers themselves. So I do kind of an online-offline combo marketing that feeds off of each other, right? So it all starts with direct mail. A couple lists that I use are mailing through probates, tax delinquencies, pre-foreclosures, and expired listings during this period, okay? I'm going to use a yellow letter, a long intro letter, and a postcard. So the yellow letter, does anybody here know what a yellow letter is? Nobody, okay. So it became pretty popular a couple years ago. It's a handwritten note on a yellow a sheet of yellow legal paper that says something like, Dear Mr. Smith, my wife and I have been looking for a house and we ran across your property at 123 Main Street. I'd love to pay you cash for your house and close quickly. Call me at this number. Well, the idea is, hey, it's a handwritten letter. It's going to look a little bit more personalized than a printed postcard or a form letter, whatever. And they worked because there was one person doing them, and it looked exactly like it sounded. It was really personalized. People picked up the phone would ring like crazy. I use these, and I would get like an 8 to 10% response rate. Like the phone would, ring off the hook. But most of the people were calling, and they'd be like, "Yeah, I got your postcard. I got your letter. I'll take $2 million for my place." Great. So, hey, the phone rang, but they weren't getting great leads. But I use this format. It's a handwriting font that I print on yellow, notepad-like paper that looks good. We get a great response rate from it. It's a very short message, and it works really well. I use this and a postcard as like my catch-all marketing. Everybody gets them. And then for the probate, we use like a 4-page or 4 or 5-page long form letter where we do a brief introduction to the company. We talk about why we're contacting them, and then talk about why what we're going to do with their house when we buy it. We include pictures, before and after pictures, and testimonials and things like that. This gets a really great response from probate leads. It's a really warm introduction when people, they want or need to sell their house. This is the time. So that's our offline marketing. Online, I'm doing Facebook ads, both paid and targeted towards our most valuable group. Anybody know the most valuable group during this upcoming downturn? Vulnerable. Millennials. Millennials are responsible for 40% of all new mortgages. 40%, it's a big number. And in the years to come, it's projected to be much higher, they're getting older, but like the point here is that you can target an ad directly to people that are 25 to 35 or 25 to 40. Right in that window are going to be the people that are going to be most vulnerable to some kind of downturn, okay? You can also target people that are, empty nesters, downsizing, whatever, but Facebook's really great because you can target your ads to a very specific group, both in location, interests, financial background, all that kind of stuff. And then general posts. You ought to have a business page on Facebook with, you know, pictures of active projects, any videos, blog posts, anything that you're doing that can add credibility to your name and presence and things like that. Instagram is great for a little bit younger of a crowd. Facebook is a little bit older. I didn't realize that I was part of like the older demographic. Apparently I am. And then last but not least is, or the last two, Google retargeting. Anybody know what Google retargeting is? I mean, come on, this has been around for a while. Nobody? All right, so Google retargeting. You ever go to a website, let's say you want to buy a pair of sneakers, right? You find this pair of sneakers online, you really like the sneakers, decide not to buy. Then you go to YouTube and you're watching a video on YouTube and this ad pops up for that website with those sneakers. Like, man, that is something. It's really weird. And then you go to Facebook and the same thing pops up and you like it's like they're following you around the internet. Well, what happens is you have this tracking pixel or this little piece of code that's installed on your website. When somebody goes and visits your website, that little piece of code is installed on their web browser. So then everywhere they go around the internet, where there's a Google, not analytics, but what is it? Google AdWords or AdSense, there it is. Where somebody's got Google AdSense installed on their website, an ad pops up. And guess what? That ad's gonna be mine. And it doesn't cost me anything unless you click on it. So here's the beautiful thing about how this works. Jason, can you, next slide please? Okay. Here's the beautiful thing about how this works. I send out a long, 5-page letter to a potential seller for a probate lien. They get it in the mail, they read the letter, they're impressed by the letter, they love it, but they don't feel like calling me, so they go to the website. It's listed on the bottom of the page. And so that's, contact one is the letter, contact two is the website visit. Okay? Once they get to the website visit, they just check it out. They're not filling out any forms, they're not giving me any information. But guess what happens? They get a remarketing pixel dropped in their browser and they go to YouTube and they're watching a video and all of a sudden our ad pops up, and that's touch number 3. Now touch number 4, they go to Facebook, and we also have a pixel for Facebook installed on our website. So on Facebook they're seeing our ads. And they happen to click on one, and when they do, they give us their name, email address, and phone number. And then on the 5th contact, they get an email introduction with some basics. That's just, hey, thanks for signing up, here's some information about us. And then better yet, they get a text message to schedule an appointment for us to come out and see their house. And all this happened without me ever talking to anybody. And now on the 6th contact, I'm making a confirmation call. So they've had 6 introductions to my company before I even have to talk to them. And now they've already scheduled an appointment to meet me, giving me all the information about the company. And now all I have to do is call them and confirm that appointment. And when I do, I'm going to ask them any other questions I have to make sure I'm not wasting my time. And following that phone call, I'm going to send a confirmation email. And so boom, before I ever see the house, we've touched them 6 different times. How many other people, how many of my competitors are going to touch them 6 times before they walk in the house? Not many. All of this happens, except this one, automatically. I don't have to do a thing before I'm building credibility 5-6 times and have to move with this, okay? So the idea behind the marketing is not just a postcard that gets somebody to pick up the phone. It's real content with a real message that, yes, I'd love them to call me so I can come out and buy their house today. But the reality is 90% of the people that even have an interest or the ability to sell their house are not going to pick up the phone today. I still want to market to that 90%. So putting together a marketing plan is going to include targeting people that are going to be impacted by a downturn, right? But also being able to implement the basic technology that we have today into our system so that a simple postcard becomes a website and becomes an ad and a follow-up campaign and a continually touching these potential sellers so that by the time I do talk to that 10% that are ready to sell today, they're really ready to sell. It's me or they're going to list a house on the MLS. No other home buyer is going to go in there and give them the presentation and give them the connection and build that credibility throughout the process. Question about marketing side? All right, now I'm gonna do a mic drop. No. I think that's, no, almost, go ahead. Yep.
When you sign up and you go to meet with somebody at their house,
Mm-hmm.
are you doing any kind of special type of contract? You know, like a 90-day close, so if it's a press and clean. I mean,
Sure.
Can you talk a little bit about how you're writing the contract with the homeowner?
So anytime I'm writing a contract, I'm gonna use a 45-day close. With that being said, I'm gonna have a conversation with them while we're going through the contract and going through the presentation that we will likely be able to settle on your house in 10 days. But I need 45 days on the contract because if there's title issues on the property, they're gonna take time to work out. And 99 times out of 100, we can get it done in 45 days. If you're that one person we can't, I'm sorry, we'll just extend the agreement. There are times when you have to close and it's gotta be 7 days. Maybe you don't have the money sitting around to do it. But I mean, I literally had this conversation with a coaching client recently. Well, what do we do if, how do we advertise that we can close in 5 days or 7 days if I don't have the cash to close in 5 or 7 days? Well, I guarantee you there's a price that you can get the cash to close in 7 days. If the sales price is $1, guarantee you probably have in your pocket, right? It's all about the price. If they need a 7-day price versus a 45-day price, they're gonna have to take a haircut. But those things matter, so if you have a lot more options when you have a lot more equity, right?
Had you ever gone under contract with somebody at a price, and then, it's like basically a press and clean, maybe?
You had to renegotiate? Is that what you're asking?
Well, no, 30, it was like a 30-day rehab,
Mm-hmm.
and then you have the option to sell it within 90 days.
Oh, you're
And you get to
asking
keep
if
the-
we go and rehab it before we would buy it, and then
Before you sell it. Before you sell it. So you go to contract for $100,000.
Right.
And then you put in 30, like you have the option to make the property kind of a pseudo renovation and then sell it before you even close on the first half.
Okay, so, all right, the question was, like, basically tie it up in some kind of agreement where I've got 90 days to close, I renovate it, and sell it to an end buyer without ever taking title.
And and you're under contract at the $100,000
Right,
and you sell
right.
it for $150,000.
Right, so I wouldn't do that mainly because of there's nothing that's gonna tie you into that contract except somebody's goodwill. And so like let's say you spend $50,000 to renovate it, right? You get the place under contract for $100,000, it's worth $200,000, you put $50,000 into it. Well, let's say you put $50,000 into it and the guy goes, you know what? Looks pretty good, I'm moving back in. I mean, you can lien the property or take him to court, but in 2 years you might see some money, It's, you want to protect yourself, like there's a big upside, but you're leaving yourself exposed. If in a perfect world, it's a great idea, but unfortunately we're all a little bit broken, and some of us, some people take advantage of it. So
Give the seller part of the upside. Doesn't matter.
you're still in the same spot, like you're exposed. Here's a good question. Jason and Chris, would you guys loan on a second mortgage if there's to do renovations on a property owned by No, I mean, it just, you're exposed. Yeah, they do, but if you, I would either escrow a title, like have the deed signed over to you or your name added to the deed, or have a deed, like an executed deed escrowed with a title company or with an attorney. In the event that this happens, the deed will be recorded, that kind of thing. That's one, anyway. Any other questions? Nothing? On any other topics? I mean, nobody's panicking here? That's great. That's really good. Okay.
Do it for round.
What's up? Oh, yeah, yeah. All right, so recap here. The economy and the real estate market are constantly changing. And when people talk about what a house is worth, that's based on this moment in time. 3 months from now, it's going to be worth something completely different, and vice versa. 3 months ago, it was probably worth something different. It's constantly in flux. And then, we're at the end of a short-term and long-term debt cycle. What's that mean? Asset values are likely going to drop. And really, now's the best time to position yourself for when it does. Yep.
What's the take right now in the market, especially like Maryland? Let's say like
What does what mean?
what's your take right now in the market? Like, so let's say Montgomery County. Can you hear me?
I'm having a hard time hearing you. You said in Montgomery County.
What's your pick? Where's the best place to invest right now?
You tell me. Where's the best deal?
No. That's not what I'm asking.
Oh.
I'm asking for your friend. You think the market is getting maybe too expensive? Or is it cooling off?
You're asking if I think the real estate market's too expensive right now?
Yeah.
Compared to what?
In Montgomery County.
Well, compared to what? I mean, what's the days on market? How much inventory is there?
A couple of years ago, like, you see houses selling for
I see what you're saying. Look, if you think it's too expensive, then look at a different market. I mean, really, like.
Do you think the market, do you think houses are selling more or they're selling less?
I think the housing prices are going to come down. How much? I don't know. I mean, and when they're going to come down, I don't know. It might be tomorrow. It might be 3 years from now. Like the problem with predicting the market tanking, nobody saw 2008. Very few people saw 2008 coming. Right? Even when the subprime market collapsed, there weren't that many people that were standing up and saying, "Really, we got a problem here, and the sky is falling down." That was a year and a half later, till we really saw, the whole process flush its way out. I can't tell you when the market's gonna correct, but it's likely sometime this year. If I had to guess, how big? Not much, But it could be big. I mean, I said earlier, there are people that are saying the stock market is overvalued by 40%, 50%. I mean, that's a big difference. I can't imagine that the real estate market would be the same. But what you tend to see when you have big market, upheaval and you go through these cycles is that prices tend to return to their value based on the rentals in that area, right? I mean, that's what they come back to. San Francisco, not so much. DC even, not so much. Manhattan, not so much. But in most markets, the values tend to return to the value of the rental. Yeah.
Thank you.
Yeah.
So if you're trying to sell a house you just renovated and the market is like this, when do you decide maybe I should rent it?
When would you? I mean, it depends on why would I determine whether to rent or not?
Well, how long do you sit if they don't,
Well, that's up to you. It's going to be different for everybody. I mean, I'll bet there were a ton of people in in 2014 that were kicking themselves. Especially in areas like Las Vegas and Florida and Phoenix, where the market shot up, it tanked, and these were the first areas that were hit, and people started freaking out. They started getting out, selling it at any price, getting out of the market. Then you fast forward 2014, the markets were recovered. They were back above the pre-collapse prices. So I mean, a lot of this comes down to understanding that this stuff's going to happen, not being terribly concerned about it, and realizing that, look, if we're looking at the right window here, and we're saying, all right, 10 years from now, give or take, this will all be over. No matter how bad it gets, 10 years from now, it'll probably be over. And if you realize that, I mean, there was an Australian company that came to New York and came to Brooklyn in 2010. And at the time, these brownstones were selling for, let's say, $700,000. They came in and started buying them up for between $800,000 and $900,000, and everybody thought they were nuts. And they bought everything they could get their hands on. Did no construction on these things, and in 2014 they started unloading them for 1.5 million, and now they're at whatever they are. They saw the opportunity in the market, they stepped in, they invested the capital, and they just waited. That's generally, time is going to be your friend with a long-term hold. In these type of environments, like, it's your best friend. You know, you're not looking at increasing the value, you know, you're not looking at doubling values in 10 years. You're looking at having exponential increases because you're buying at an artificial low because you knew it was coming. Yeah. That's it. That's all I got. Yeah, keep going.
Based on what you just said, my name is Garrett.
Yeah.
Currently my partner. We're investors and contractors in Baltimore. Based on what you're seeing now and the projection everybody's seeing, are you realizing that hard money bankers are doing better rates to attract guys like us?
Here's what happens. When the market gets crazy, guess what happens to all of the national lenders that are lending at 1 point and, you know, 1% interest? They're gone. They're on. I mean, that's one of the things that you'll see first. All of the noise of a lot of these lenders who are backed by institutions, they're backed by an institution with a line of credit. The institution pulls the line of credit, now there's no money to loan. And so you end up with typically higher hard money rates, wouldn't you say? Like there's less capital in the market, and because there's a higher demand and less supply, the price goes up. Now that correlates though with lower values and deeper discounts. I mean, it's what happens when there's less competition, you know.
Probably where you're at, like we're in Baltimore.
There you go.
It's a little different.
Right, I mean, and it's, in Baltimore, I'd say it depends on the block, right?
Exactly.
Like, yeah.
Any hard money loans? Please leave your card.
You're up.
Cool, thanks, Josh.
Thanks. I know.
Josh is sticking around anyways, because we have a few minutes to do our expert panels. So let's do this. If you've ever been here before, you know exactly what these are. You get the opportunity to speak with a lot of local experts that are doing deals, different types of strategies. So Ian Horowitz, rental property guy, owns a ton of rentals in Baltimore area. Why don't you hang out around here? Terry Royce, wholesaler, let's shoot you in the back right hand corner. Tony from Hard Money Bankers. Where's Tony? Is he still in here?
He's right out there.
Tony's going to hang out right by this jukebox. Scott from Eastern Savings Bank. You own rental properties, you need bank loans on those. Scott's man. We'll put him under the TVs. We have Shane, who does our Facebook ads for Hard Money Bankers. He does Facebook ads for a lot of other local businesses and real estate investors and agents. Why don't you stay right there? He's right here with that.
My drink.
Good. Josh, you hang out over here in this little area. And any questions that you have, well, utilize these guys. They're a resource. They're all local. They're all doing deals regularly.